I have my colleague, David Friedman, join me for the financial projections presentation, and I would like David to introduce himself for those of you who don't know him yet.
Yeah, first of all, good morning. Thank you for joining, and I appreciate, Laura, the opportunity to participate. I was a former tech executive. I turned angel investor back in 2009. I guess this is my fourth career. I'm currently the president of Tech Coast Angels in Orange County, vice chairman of its board. And I have invested in several different companies, mostly in tech, because that's my background, but also in biopharma and med device. So I'll give you some perspective, hopefully, on what we see in investing in startups, the good, the bad, the ugly. Any question that you want to ask is fair game. I'll try to answer it as directly as I can, as I'm a New Yorker, and there is no kind, it's just a very direct answer. You'll get what you need very quickly, hopefully, and it will be useful. That's what I trust.
Thank you, David. That's why I love having David present, because he really does give you the answer right away. So again, what do we need to cover today? We talk about what makes a startup investable. We'll talk about financials and pitch decks as far as financials relate to the pitch deck. We'll learn about how to construct them, sort of understand what investors are looking for. We had 4 modules. This is our 4th module. Our first one covered unique value proposition, and we went over market opportunity team, and today's, again, financials and how to present them in the pitch deck. Quick recap, what makes a startup investable? You have to have a unique value proposition. It has to have an attractive market size. Again, for the investors to have an opportunity to make money. It's not a guarantee, but the market has to be big enough to have that opportunity to make money. It has to have a team that can execute, and you have to convince investors that your team can do that. And finally, it has to be a startup that makes money for investors. And that is probably key to differentiating an investable startup and the startup that can be a great business, but not necessarily investable. Because not only your company needs to make money for you and everyone in the company, but it has to make enough money to make money for investors. And your deal has to be attractive for them to invest. So quick recap on the value proposition. Remember, I like to say it, customers really do not care about your product. They don't care about your service. They have a job that they're doing that needs to be done, and they need your products to finish that job and to do it better. But it's the friction that they have and the pain that they need to eliminate in the process of doing this job, or there's certain gains that they want, the speed, the cost, new ways of doing it. Again, if you can deliver that, it's either a pill or it's a vitamin, right? You create a pain reliever, or you're creating a vitamin, something that enhances what they're doing. But again, they don't care about your product. They don't care about the features. They care about what benefits do they gain. This is the formula we used for articulating your value proposition. Those are all the components of it. You have to specify who's the type of the customer that will be buying your solution. What is the job that they are doing? And if you're offering a solution, what is it? And how does it result in allowing them to do their job better, which means either gain or eliminating of the pain. And you always want to say about why you do it better. David, do you want to give an example? I know you have an example of using this formula, but on a real
I thought it was appropriate. I mean, when we look at things, the only thing you really want to do when you talk to an investor is get them to say one thing. Tell me more. I mean, it's a successive series of these until the investor says, I don't need to know anything more. I'll give you money, which is the ideal of ideals. But let me give you an example of articulating the value prop. We call this the elevator pitch. And this is, I wrote this one, and it's pretty much of a true story, and one that I had heard maybe 10 years ago, and it really stuck with me. So you'll see the various components as you listen. My name is John, and I have a PhD in microbiology, and I work for the largest pharma companies. My brother, sister, and mother all have had cancer. I have a goal to help them and others fight this disease, and I won't stop until I'm successful. I developed a diagnostic test based upon a sample of blood that is unique in the market using CAR-T. The cost is less than $10 per test. Unlike other screenings and tests, you don't need a doctor's prescription, and you can do it in the privacy of your own home. The tests have shown a 98% success rate on detection and can be used as a standalone or in conjunction with other lab tests. So I've clearly indicated who the customer is, what job is going to be done, the solution that's offered, and the benefit. It eliminates pain or shows you the gain. The gain is, a successful diagnostic. And the key that I find is this concept called unlike. It puts you in opposition to where the competition is or what currently is available, and gives a context to the investor of where things are. So that's an example of an elevator pitch. I'm more than happy to throw it into the chat box. You guys can dissect it, use it, not use it, or whatever.
Thanks, David. So going back to what we have covered, just a quick recap, we did cover the market size and how it gets articulated in the pitch deck. It's your TAM, SAM, SOM. So now we'll move straight into financial modeling, design concept, and what do you need to do to satisfy investors during your pitch. Again, we're not covering how to do complete financial modeling. It's the key here is what do you need to know for your pitch deck so that you can talk the same language the investors do. So when you look at financials, there's methodology plus assumptions, and that's what produces financial projections. Unfortunately, you can't really play with methodology. That's your GAAP accounting, right? Your assumptions are the only things you can change in order to get different results. And I know a lot of startups complain that they don't want to do projections because they're all guesswork. However, it's all about the assumptions, and it's the assumptions that investors are interested in, right? Because they are producing the results that you display, all your revenues, all your EBITDAs. David, I don't know if you want to add anything to.
Yeah, I think the issue to us is, I look at different things than other people. I look at the financials as just something that's there. Other more financially oriented people focus on the financials, but in a startup, as Laura said, you really don't know. So what we want to understand is the thinking through the business model and how they all piece together. Is it logical? And just as important, do you understand where your bump points are, your risk points are? And how is the executive team going to handle something an adversity that comes up? So we really are concerned with the logic, the thinking, and whether or not the team can perform in executing the plan and can pivot if need be.
And we wanted to address quickly that there are different stages of startups, and we're really focusing a little bit more on this on the startup at the very early stage. But you have sustainable growth stage and you have high growth stage, and those are different stages, and they reflect in the financials. So when you first start thinking about your revenue, because that's the top line, that's what you need to put down on your financial projections, usually 5-year projections, right? What drives your revenue? And again, we're going back to the assumptions. What are you assuming is your price per unit that the market can bear? You still have to test it, and you have to prove to investors that you actually did not just pull the number out of the hat, but you did research your competition, you research the market, you talk to the customers. The volume, again, sometimes we see numbers that are just not realistic if it's something that needs to be manufactured, and it may not be possible to manufacture in those volumes based on the cash that you have or the resources that you have. And then finally, it's the net growth. That's your third biggest assumption. And David can talk about the net growth because of the issue that he's seeing all the time coming up now, where instead of just growth rate that we used to talk about, we have to talk about net growth because of churn.
Yeah, so let me just chime in. One of the things that I suggest all the entrepreneurs do is take a look at who your target is and segment that market. For example, you may have what we call routes to revenue, different revenue streams. Some revenue streams are due to the fact that you have different product lines. Some revenue streams are due to the fact that you're in the United States, and then you have rest of the world or certain other geographies. The more precise you slice and dissect the market, the better off you are. It shows you that you have different ways to generate revenue and not reliant on just one. But the other thing that Laura pointed out is this net growth. We're seeing a lot of businesses now in what they call SaaS or subscription market, and subscriptions and SaaS models are reliant on a customer continually buying the service over time throughout a contract cycle, for example. So one of the questions that we ask two questions: what's the cost of acquisition? How much does it cost to get a customer? What's the long-term value of the customer? They kind of go hand in hand. And the other one is churn. How much are you churning? Is there history, given, even though you're a startup, you may have seen that 90% of the people that have signed on and have given you revenue over the last couple of months are continue to buy. Is that good or bad? That's all relative to the competition, but it's something that you should know about. Revenue, cost of acquisition, long-term value, and churn.
So once you articulated your assumptions about the revenue and you put those numbers down, we all know that revenue drives your costs too. We're talking about variable costs for the most part, but you also have to make sure that you cover your operating expenses, all your assets that you need, because you need to spend money on the IP. You possibly are purchasing equipment. But that is something, again, they are assumptions. And a lot of times you may not know the final numbers, but if you don't know your COGS, in case of a product, right, your cost of goods sold, that's a problem for an investor. You can't just put something that doesn't make sense. And again, going back to the competition, going back to the customer, will they be willing to purchase at the price that you want to sell it at, giving you enough resources to produce it and still have a healthy margin? David, what do you see with expenses? What are the issues that usually come up that are red flags? Or
well, it's interesting because expenses tie to the manufacturability, but what we see in expenses that creates a concern is the shaping of the market expenses, how much money you need to do to get your idea into the market and accept it. So the newer your product is to the market, a change in the way somebody does something. For example, in the medical profession, we've seen a lot of new inventions come in. If it's a big change in the way people have done things and it's not accepted in the practice, then it costs money to be able to get over that hump. So you need to be able to spend a lot more money up front in the marketing of a new to the world or new to the company type product than it is if it's just a line extension or direct competitor. So take into account the amount of money in marketing up front to de-risk the investment for the investor.
And it goes back to your problem and the solution. And if the problem is not known to your customer, you have a problem. Because then it becomes an educational sale. It is clear to you how valuable your solution is, but if it's not clear to the customer, not necessarily in your conversations, because when you talk to them, you may get very positive results, right? Everyone is saying, oh my God, yes, that's something that I would absolutely buy. However, how will they find out that you even exist? So even if your diagnostic test is 100 times faster, unless someone knows about it, you still have to spend those marketing dollars getting out there.
Yeah, and the marketing dollars will include things like public relations, publicity, trade shows, and don't forget third parties and influencers, because they become, especially in today's world, depending on what products you have, because of social media, it's important to be able to leverage those, the influencers to help get the word out on your product and also get positive testimonials.
So this is a sample pitch deck slide. This is really what investors are looking for. You have your line items that you can see. Again, cost of goods sold applies to products, not services. You may have a separate line item for salaries and wages, or they may be part of the R&D, sales and marketing, and general administrative. Again, David, what do you see more often? And I know there are problems with salaries and wages that definitely come up when.
Yeah. So I see these categories, they're fairly well standardized here. What I would like to see in the pitch deck, as I mentioned before, is instead of, I'd like to see gross revenue for one thing, not net necessarily, for a variety of reasons. And I'd like to see the different ways you're going to get that revenue. What are the buildups by product line and by geography? But I think it's important to want the things that I look at. And when I look at the revenue, call it whatever you want, I look at that relative to R&D and sales and marketing. And then I correlate it with the industry. Am I spending more or less than somebody else? If it's a new to the world product, again, as I mentioned, I need to spend more proportionally on sales and marketing in the early years to make sure that people become aware of the benefits of our product. But the real reason for looking at the revenue is we want to see two things. Is it a large enough market for us to invest in? As Laura said, there may be great opportunities for a lifestyle business, and $15-20 million with a 15%, 20% margin is great. You can make a nice living on $2 million a year as the owner, but it's not necessarily what we want to see. What we're looking for is the revenue growth substantial so that somebody, potentially another private company, an equity group, a VC, will come in and buy the company at a 10x times something. So there are a couple of ways, and we'll get into valuation, that we value. We look at, especially in SaaS businesses, we look at the revenue and we look at an exit potential between 6 and 10 times revenue. In other kinds of companies, we look at the EBITDA and we look at a multiple of EBITDA based upon the kind of industry it is, and that gives us a correlate for exit. And we look at those numbers and those metrics relative to what has happened in the market, relative to what competitors have bought. Maybe they bought other companies. And so that's the way we kind of look at the deck. So we look at growth, we look at routes to revenue, we look at, the multiples, for an exit. That's fundamentally what I do. Everything else, cash, and we look at cash flow, which is important. I mean, I'm not a big financial guy. I always look at the financials or an outcome, not an input. Other people don't look at that. But again, it's a logic, but it also relates to how much money we can make as an investment.
Mm-hmm. And again, the slide that you're looking at is your most generic slide, right? So if you have, let's say, hardware component and you have a software component, you would break out your revenue based on that. So you have your net revenue, but you actually specify.
Yeah. And it's different in a medical area where we don't even want the medicals to get, some of the medical startups to get into the market. We would like them to exit, right before the FDA approval. Let some other bigger company, spend all that money. So this is true of a technology company, of a CPG, of a services company, of a software and IoT company. In the medical area, we may never see this for years and years. Mm-hmm. We'll look at a little different criteria.
Yeah, and as far as the pitch deck slide for financials, in those cases, those questions come up all the time. What are you looking for? What should they be putting down? What shouldn't they be putting down? And which year should they start with?
Well, I think they should start with the current year. I'd like to at least see how much they're going to spend over a period of time. And even in some medical areas, because you have to change the behavior of some of the practitioners, you're going to spend money early on in trade shows and publicity, in conferences and sales and marketing to shape the market for that kind of device. Eventually, we want to see that this will be commercialized, and if it does get commercialized, what would it take? Again, it's the understanding of the logic that the executive team is using in putting together the numbers versus the actual numbers. We know the numbers will rarely, if ever, be correct, but the logic and the understanding, the assumption set will be pretty much on point.
Mm-hmm. So sometimes the question is when an entrepreneur wants to license a technology and the pushback for making financial slide is we're just licensing. We don't need to do projections, and it always has to come back with, well, show the investor the reason why someone would license it.
Yeah,
and the number.
but even in licensing, I mean, if you're a licensing, that's an interesting point. If you're a licensing company, you have a very different perspective. So one of the things I like to see on a slide deck is a line item on the bottom, at the very bottom, the number of employees. And in many cases in the biopharma area, I also want to see salaries, because I've seen a lot of the executive teams paying themselves a significant amount of salary, but not having the results. I also want to see how far they've come in the past. How many years have they been in existence? What happened before 2021, 2020, 2019, 2018, 2017? How much money have they spent, and how much money have they burned to get to where they are today? All that comes into play in certain kinds of businesses.
Mm-hmm. And that usually is articulated when you have your slide on the ask, and you are saying how much money it took you, how much investment you took in, how much founders put in, and we'll show the example of the slide. But the other item that I wanted to address is including some of the assumptions that help investors process the financial slide like this. And that's where I like to see, for example, above net revenue, for example, a number of clinics that you need to reach in order to get that revenue, because sometimes one clinic gives you, $1 million, right? And sometimes one clinic will only give you 500,000. It makes it easy. And I don't know, David, you process slides different than I do. I like to see those numbers because they help me quickly do the math, how many customers you need to get to that revenue, as opposed to just the revenue number.
Yeah, so I think you're right. It really just depends on the context. For example, let's say I'm a marketplace, because you're in the more of the medical field, I'm more in the tech field. But let's say it's a marketplace. In the marketplace, I'm generating a significant amount of revenue or sales. Look at Amazon, how much sales goes through their system. But in essence, they only get net revenue. So I'd like to understand both, actually, because I'd like to see if in fact there's going to be a pinch point in some other maybe marketplace coming along and taking away margin. Now I have to cut my transaction fee. So I think the issue to really resolve it for most is if there is gross revenue and then there's net revenue based upon either transaction or some licensing or something else, put down both. It's only one additional line item. And we've seen that happen in many of the investor pitches.
Mm-hmm. I would like to see if anyone wants to ask any questions about the financial deck before we start moving on to the ask and the valuations, because I know, and I would rather have you just unmute yourself and ask a question versus putting it in the chat box. That saves us.
I'm more interested in knowing if anyone online has ever had a forecast that's perfect.
That's a trick question. That's not.
Yeah, well, it's an interesting question. If anyone says yes, I'll give you money right now. I'll use Laura's credit card.
So do we have anyone who has a question? Please unmute yourself.
I'll ask a quick question on ratios, and obviously it depends on the industry, but I've always been a ratio guy. I would want to know my rent towards sales and labor towards sales. What are your thoughts on ratios?
Yeah, absolutely. Well, 100%. If you can, that shows knowledge of the business. That goes to whether or not we believe in the executive team. The best executive teams know everything and anything to do with the metrics involved in making their business. I was in the cellular business at one time. We use ratios of everything, sales to revenue, cost of acquisition, churn, and we used to measure it and move and strategically try to make sure we got better in line with the metrics. So the more you know, be it cost per square foot or cost per manufacturer or cost per gross ad or churn, all those things are really critical. You may not necessarily have to put them into the pitch deck, but what I would recommend for anyone pitching is a list of questions that the investors will ask. So one question might be, to your point, Doug, what are the metrics used to determine success? And have that answer in your hip pocket. Don't share it. And, so you'll hear questions that come up today. You'll hear questions as you pitch more to the investors. Put those down, put them in an FAQ. Well, it doesn't make a difference if it's 10 or 20 questions, but having them prepared a priori will help make you as the CEO appear a lot stronger in their eyes. Knowing your business is a very, very good thing because it makes us believe you are de-risking it because of your knowledge. And that's an advantage.
And just one thing to remember is do not, like David already mentioned, you may not want to put it on the pitch deck itself, because we've seen a lot that, a startup goes through a pitch, they get through Q&A, right? And it can be a 15 or 30-minute Q&A. They get a lot of questions. And next time they show up, they have all those things in the deck. And all of a sudden your deck, from being nice and clear and concise, becomes a total nightmare. So those things are, they can go into appendix. So once you pitch once and you get some questions and you have those answers, put them in the appendix, have them ready. Sometimes it's just a due diligence, even on stage. So David, you can talk about the difference, what you're looking for in due diligence, because a lot of times, again, the financial slide is thrown there to just give a quick overview. You're glancing at it, you're looking for some anomalies, but it's in due diligence when it really becomes important, and it has to match to, so that there are no
so in due diligence, normally we put together a team. There's a financial group that delves into the financials. Do the numbers make sense? Let's say you have EBITDA in the first 3 years that's negative $3 million, but you're asking for $1 million. That gives us an indication you're going to go out and get another round of financing. Then we'll look at cash flow to make sure that you're going to go to that round before you run out of cash. Otherwise, you'll be a fire sale. So in due diligence, it's just like dating. I really like that person. I'm going to go date that person. And the due diligence over a period of time, and in our case, very short period of time, do we want to get married to that company? Because as we invest, we marry the company in essence. So you peel back the onion, you ask more questions, you probe into the assumptions. Does the assumption make sense? Can your team execute on that plan? Is your sales correct? Going back to Doug's question, do the metrics make sense relative to what's out there today? How big is the competition? Does the competition, are they going to feel threatened by you? Are they going to put more marketing dollars? Do you have that wherewithal to put more marketing dollars in? And the other thing that I would look at in due diligence, and it's not covered here, is a thing called risk and impact. What are the risks? What are the 3 or 4 or 5 risks that you guys face, women face in the business? How do you codify that risk early on before you actually face that? And what would you do should that risk occur? Is that risk a big risk with a big impact, or a risk that you can manage? Those are the things we look at in due diligence, but it's basically peeling back the onion until we feel we're comfortable enough that your team can execute on the plan that you delivered and the market is large enough and we can make money given the deal structure that you have.
So Doug, you asked about the questions that kind of dove into the Q&A area, and so what we have on the screen now is those are the questions you may be asked, and you have to know, but not necessarily have on the slide. So like sales activities and metrics, we do look at it closely. Sometimes you customer acquisition costs, sometimes you don't. A lot of times during the awareness stage of when you're going and you're putting marketing dollars into just generating awareness on your first sort of leads, even if the leads are not even there, you just awareness. What investors are looking for is, have you figured out the formula to get to your customer and get them to bite? Or are you just promising that once you get the money, you're going to start throwing those marketing dollars to generate that formula and dial your marketing message? So there's a lot of things that can be done before you even get to your first sale or your first customer. And those marketing dollars can be spent on that. But a lot of times you want to have that already in place. So if you have someone doing sort of pre-marketing work, that's where it's going for. Because if you can tell the investor, look, we've done 10 different tests, we tested different messages, we went after different segments, and we had to pivot. All those become part of the story that builds your credibility, because now you have the formula. If they give you money, that will, if they put a quarter, they'll get $1 back, because you know the formula. I'm going to bring back the previous slide and see if anyone else wants to unmute and ask a question about how to construct this in their particular case, or have any comments about how they did it.
And you realize, everybody, when you look at EBITDA and you look at gross margin, they vary based upon the industry. So, you can't really say that, gross margin is going to be 60% or 70%. You have to make it, put it in line with what the other, competitors have out there. And take a look at 10K, take a look at Free Edgar. If it's a public company, see if you can go on Capital IQ or Pitch Deck or Crunchbase and see if you can glean information from what your competition is doing. Go on LinkedIn, go on SlideShare. Sometimes, a lot of these companies share their information in a pitch. Take a look at some of the older pitches that were successful and the ones that were not. It's a lot of work, but, have really good information, really understand your business, the environment, the economics, and the complexity of the competition.
Any other questions before we move on? Okay. So we already talked about the Q&A session. You need to be prepared. You can have slides in your appendix ready to go. So we're going to go back to cash flow, because cash flow drives your ask. So a lot of times, it seems like almost everyone is asking either for 500K or for $1 million, and the number seems to be random, because sometimes they hear that, well, that's what angels are looking for. They're not going to give you more than 500K, or they're not going to give you more than X. But the bottom line is, you can't just blindly follow what they're asking you to put on the deck. It is driven by the cash flow. And David, I know you have some strong opinions on when you look at it. And you already mentioned, you already look at the financials. If they're going to run out of cash and they're asking less than none, that's what's reasonable.
Yeah, I make sure that if cash is king. I mean, especially in a startup, we want to see your cash burn, which we didn't talk about. So seeing what your monthly burn rate is great before you get money and after. We've just seen, after people have gotten funding, their cash burn increase because their salaries just, try to make up for the past. Everyone has a right to survive, to subsist, but we really don't want to see your salaries going from $50,000 to $150,000, $200,000 a person, and we've seen that. Sorry, we hate to say that to you, but it's the reality. But when we look at the burn rate and we look at the cash flow, the concern we have is, will you have enough money to get to another metric, another success point, either the sales or the distribution partners you have, or a product into the market, or a new prototype. And we want to make sure that you have money to get to that point. And before you go out with the next round, have a buffer of 6 months to raise additional capital. So you don't want to just time it so that at that point when you succeed in hitting that metric or milestone, you're now trying to get capital again. If you run out of cash, you're now a fire sale. No one likes a fire sale. So you got to think about your ask relative to your whole raise strategy. Where are you going to raise the next round? Are you going to go to a second seed? Are you going to have a bridge to an A through a convertible note? Are you going to, look at an A round? Who are you going to look at? Are you going to look at angels that have invested before? In the early seed, you have pro rata rights. There's a whole bunch of terms and conditions and things you need to think about in your whole structure to look at raising money. And that's something that is all driven by cash flow, P&L, and the team. But that you have to figure that out. And that's not really covered in this pitch, but the deal structure, the deal flow, and getting funding for the future is really critical.
David, your personal preference on the financial slide, do you like to see the cash flow right on the financial slide, the 5-year projections? Or
I don't care. I don't really care about cash flow as much as I care about burn rate relative to the ask. So a cash flow statement is nice. I mean, it's important. It doesn't have to be on that slide. Very rarely, if I've ever seen it, on the P&L slide. But the EBITDA gives me an indication, gives most of us an indication of how fast you're going to need capital. Okay, in the due diligence, we may get into how you're burning cash, where are you spending it, and then we can get into discussions. But to get to the point of due diligence, we don't really, normally we don't look at cash flow per se, a cash flow document, but we will look at the burn and we will look at the EBITDA.
So again,
I got a quick oh, I'm
Sure.
sorry.
Oh, no, perfect, because I was going to ask if someone has a
okay.
question.
I've always put contingency numbers in my cash flow.
Good. That's what you should do. I mean, you should have at least a contingency somewhere. You can either put it as contingency or something else. The other thing you can do, by the way, which is not normally done, but it goes into what I was commenting before on risk and impact. You can do a sensitivity analysis, not necessarily sharing it with the entrepreneur, with the angel investor early on, but you can say, look, we've modeled this on a slow growth, medium growth, conservative growth, fast growth, and here's where we fit in. But we've taken into account the cash burn and the ask relative to what we've seen in our sensitivity analysis. That's another way to look at it.
Yeah, and again, that's not for the pitch deck slide. I've seen startups that try to put it there, and it's too much because it's a quick pitch, right? There's only so much information an investor can process. Like David said, you just want to get them to the next stage where they're saying, please tell me more, and they will look under the hood and they would like to see the modeling and sensitivity analysis.
Yeah.
Any questions again on the financial, the 5-year projections before we move on to the valuation?
Build it up with a good spreadsheet. We can then take a look at the spreadsheet and look at the assumption set. So, if you need an Excel maven to really put it together right. I'm not an Excel maven, but I can follow my logic in the spreadsheet because it's just brute force. But I need to but in the Excel or whatever system you use, make sure your assumption sets are very clear so we can model it and change things around. And this only when you get into due diligence. It's not going to be done when you make the pitch.
All right, so we'll switch gears. And if we don't have any more questions on the 5-year projections, let's go to valuation. So again, we said that the cash flow needs drive your ask. Part of the ask is inevitably the valuation comes into place. And it is driven by your revenue growth, your risk, and your competition. So it is different for a startup versus an established business, right? We're not really looking at the future value of cash flow. We're looking at traction and growth. We're looking at assumptions and how realistic they are. But you still have to use them. You can't. So probably the most common, David, pushback we get is for valuation is someone just multiplying EBITDA and putting it as a valuation and completely disregarding risk, and then wondering why investors are not buying into it because the numbers seem to support the valuation.
Yeah. So what we've seen is, and it goes to what Laura was saying, in a company that's an ongoing business, you can use the present value of future cash flows and a residual to come up with the potential value of a company. But the valuation of a startup is more of an art than a science. There are a few different methods that are used. One is comps. You can look at what other companies have been valued at the stage that you're at. That's a good one. The Berkus method is another one. where, if you have an idea, it's worth this. If you are in prototype, it is this. If you have early growth, it's this. That valuation varies depending upon the market space that you're in. But a lot of companies come in and say, I'm valued at a couple of things. I went up to the Valley, and the people in the Valley, I met with Andreessen, and he said, your company is worth $50 million. So they come back down to us and they say, we don't think it's really worth 50. We're going to give you a discount. We're going to say that the value is $30 million, and they basically have $10,000 a month in revenue. So my comment to them is go back to Andreessen and say, you invest and we'll follow on. Because what you hear is valuation numbers spewed by the Valley, which don't normally correlate with what the angels value a company. Because remember, VCs you're already in growth mode. There's at least a good significant trailing revenue and financial stream attached. When you're looking at an angel investor, which like my group is, you're looking at perspective and you don't have a really good history, even if the market space is fairly well known. So we look at trailing 12 months, we look at competition, we look at, how, what the values of competitive products and businesses are. We look at traction, and then we look at your IP. We say, here's a good baseline, and we add or subtract from that. But remember, in valuation, it's sort of a negotiation, and it has to be fair on both sides. So we look at eventually what the exit potential, again, going back to your P&L, based upon multiple of EBITDA or multiple of revenue. And we look at what the investment deal is today, and we see if it's realistic. And then we may debate, determine, argue, but eventually we come to an agreement. So it's, as the chart indicates, there is a premium, and we're seeing increases in valuation over a period of time. It used to be that in a startup, it was about $2.5–3 million, for a valuation. Now we're seeing 7, 8, 10, 15, 20 million. It depends upon the market growth, what's hot in the market. If you're in 5G or diagnostics or CRISPR, you'll get a more of a value, a higher valuation. The management team makes a big difference. If it's a team that has been together a while and has successful exits, will bump the valuation up. If you have an entrepreneurial culture, that's great. If you have revenue predictability or de-risking, that will also improve your valuation. But valuation, again, it's influenced by the investor, influenced by the competition, influenced by your team. And there is no one number that you can just put into a black box and come up with an answer. I'm sure you didn't want to hear that vagueness, but that's the reality.
Well, it's good and bad, right? So this is we'll put up an example of an ask slide. This is what you are expected to have on an ask slide. Now we're using convertible note here as an example, but there are other mechanisms, but you have to specify what they are. So when we talk about prior investment and what founders put in, this is where it goes. Again, investors want to make sure that you invested yourself, your family potentially invested, and then you specify again, it's a negotiation, but you specify the terms. David, you are seeing mostly convertible notes right now, correct? You're not seeing a lot of safes.
Well, we prefer preferred shares. Convertible notes have some interesting issues relating to tax, for example. We don't really like safe notes. We don't really like KISS unless there's a conversion principle. But we see a lot of convertible notes, especially after the first seed going to a bridge to an A. And usually a 20% discount makes sense. We've seen caps on notes, that are anywhere between, 2.5 million, 3 million, up to 15, 20 million. It just depends on the business.
As far as the initial pitch, do you recommend being more conservative and being more realistic, or do you recommend more going bold and hoping that during negotiations you will get a better deal by negotiating versus upfront putting numbers that you think you want
I
to
think
get?
you need to be realistic up front and say, you know, we believe our company is worth this. We want a convertible note for the following reasons. We're not exactly sure what's going to happen, or we're in a high growth mode. But when you do the note, you put the cap on. The cap is in a sense a proxy for the next round. So we either get 20% discount off the next round or the cap, whichever is more beneficial.
Anyone has questions on the valuation or the ask? Again, just please
David, this is,
unmute.
yes, David, this is Tom Nichols. Question regarding, you brought up the point IP. Is there a strategic valuation betterment if it is pending or if it's actually issued? And how do you address that in your pitch?
Yeah, you basically say we have a patent pending. It's a utility patent, or here's the essence of what the patent is. We can make a quick judgment, but even with IP, we don't know with any certainty whether or not the IP is strong or not. And IP is only one aspect. IP is a patentable. Some people don't put IP together. They want a trade secret. Some people look at the strength of the company as not necessarily the IP, but the relationships with partners or distribution, or the unique skills of the management team or the CTO. So IP is just one thing that we like to hear about it, but until you peel back the onion in due diligence, when we get into it, we really don't know how good or bad the IP is. There are a lot of utility patents. Some of them make sense, some of them don't.
Any other questions?
I have a question. I was currently seeking money just for the manufacturing of a product. I'm at a working prototype stage, but in listening to all of this, I'm realizing that I'm also probably going to need the money for third-party logistics, and who's going to pick it up from the port and store it and ship it and all of that. How do you put that into the financial model?
Yeah, it's part of your cost of, it's either part of your cost of goods, or you put it into SG&A or sales and marketing. It's in one of the categories. But
Okay.
whatever the major, you can, here's the major categories. And it's different in different companies. So there's A, B, C, D, and E. And then you can always put down miscellaneous other, including blank, logistics, legal, chauffeur, cook, whatever. Again, it just has to be realistic more so than it has to be prescriptive in terms of a specific category.
Okay, thank you.
I have a question, Dr. Tom. Okay, I have a client. He has an amazing IP product, right? He thought he was a manufacturing company, but he's not. He's really a design company. His IP is one that he has to, somebody else will manufacture products. They need this design to implement into their products. It's going to be extremely viable for 3 different industries. The question that I have is, right now he's going for US grants and all of that. He's talking about going to out to angel investors. My challenge with him is 2 things. One, he's an engineer. He's not a business guy.
Yep.
Okay. Great idea, but he's definitely not the business guy. He's done analysis for the grants, but it's really questionable right now as to what the market opportunity is until he has money to get into that with the industries. And we're talking, it's something that could be used for Internet of Things, both industrial and in home, as well as electronic products.
But what's the question though?
The question is, how does he go towards angel investors? How do I package him for that when we're unsure of his actual market's value? Shall we just stay with grants?
I would, well, first of all, grants are great, especially if they're non-dilutive funding. I would put that into the ask, in that ask line, because that's really strong. Number two, if he's an engineer, he has to balance his team out with a business person.
Right.
Okay. Number three, if you don't know what the market is, if you don't have a good perspective on it, don't go to an angel.
Okay.
Go to friends and family, let the people, see if you can get money there. You really need to know your market and your business before you go to an angel. Otherwise, you won't pass our screenings.
Yeah, that's what I thought, but I just wanted to ask the question.
Yeah,
I think that becomes.
I have a hard stop at about 10:00. I have a hard stop at 10, but I'll go to about 10:04. But I'm going to put my contact info in the chat box for anybody. People have sent me some little notes, but if anyone wants to talk, you can get to me through Laura, the SBDC. If I can help you out somehow.
So we'll move forward then with the use of funds. Again, that's a slide that you would need in your pitch deck. Once you asked for what you're asking for based on what your financial needs are and the cash flows, right? You have to articulate how you will use the funds. The most common way is to give a high level overview of what you will be spending. It can be done in a pie chart where you do percentages, or you can do a specific dollar amount. But what we'll look for is how will you allocate those resources? How much will it go of the money will go towards sales and marketing, for example, and that's a big one. That's the one where we want to see a lot of money going towards it. Obviously, if it makes sense, right? I mean, you have to have built a case that you know your customer, you know how to get to them. Now you just need money to do it. The tricky part is obviously R&D, right? If you still need to do R&D, that has to be accounted for. Again, in the prior decks, in the prior slides, you should have articulated what milestones that R&D will get you to, because that's a potential acquisition at that point. And you can get a little more detailed. Again, here you can see that under R&D, you specifying software, prototype, regulatory. And then you have your general and administrative expenses, sort of your essential infrastructure to run the company. That's the format that you can use. Again, you can do it visual in a pie chart, percentages versus numbers, but that is what we're looking for. And David, do you want to comment on what you see, or bad things you see, good things you see?
No, I mean, these are the general categories, and in a pitch deck, that would be great. In your FAQs, have a little more detail on sales and marketing. Just putting down sales and marketing is just too broad. You may want to segment that down into social media, influencer marketing, partner marketing, because in the due diligence, we'll peel back that onion and want to see an actual marketing plan for the next 2, 3, 4, 5 months.
Unless you already covered in the go-to-market strategy. So in your slide that is labeled go-to-market strategy, you're actually saying we're spending on social media, we're spending on influencers.
Yeah, but it's a matter of detail. I mean, that's the point, so having a go-to-market strategy says influencer, social media, those are all just words. What we really like to understand, not only, so the go-to-market strategy is normally a strategy. What I want to see is in the due diligence, a go-to-market strategy translated into a tactical plan, which is specifically what are you going to do, what you're going to spend, and when.
Okay, and before we finish, if there are any last-minute questions, just a few disclosures that remember there's no one way to do a pitch deck. There's no formula, and don't get frustrated when you get advice that sort of seems to be contradictory. The fundamentals are always the same. Again, you're pitching to different audiences, and you need to know your audience that you're pitching to. You can't ask an angel group to invest in a startup. That doesn't make sense for an angel group. Same thing. You can't throw numbers on the ask slide for an angel that are more VC type investments. And that's there's no unfortunately there's no easy answer. There is no clean cut formula. It is an art and the science, pitching, and your financials are the backbone. You are articulating your assumptions. Again, it's not about them being right on the numbers. It's telling an investor how you think about your business and what you are assuming, because then they can challenge the assumptions. They can't really easily challenge the numbers that you throw on the deck, but they can challenge the assumptions, and they make the decisions based on the assumptions.
Yeah, the one thing that I'd recommend, by the way, is attend pitch competitions, listen to how people present their elevator pitch, really nail your elevator pitch, the chart that Laura showed, the 4 elements early on, because without that context, you don't want the angels to have a blank stare. And the way I constructed it is to build the relationship with the angel, put the angel investor or the other investor in the shoes of the buyer or the shoes of the user. You get that rapport, and then you have the potential, higher potential, to have them say, tell me more. So build a relationship, tell your story. All these points that Laura pointed out are part of the storytelling. So how you tell your story is great. If you don't know how to tell your story because you're an engineer, use Laura or one of the other SBDC people, help tell the story. They can help you out.